Have you ever wondered why central banks print money? Hello everyone, welcome to our channel. Today we're going to talk about a controversial topic that affects us all, money printing. First, let's define what we mean by money printing. Essentially, it refers to the process by which central banks create new money out of thin air, typically by buying government bonds or other assets from banks or investors. This increases the amount of money in circulation, which can have various effects on the economy and society. Now, why do central banks print money? There are several reasons, but the most common one is to stimulate economic growth and prevent deflation. Now we are briefly explanation of why money is printed. To stimulate economic growth. To stimulate economic growth, governments and business leaders often focus on implementing policies and strategies that encourage investment, innovation, and entrepreneurship. This can include providing tax incentives and subsidies to businesses, investing in infrastructure and education, and creating a favorable business environment through deregulation and other measures. Additionally, promoting international trade and collaboration can also help to stimulate economic growth by expanding markets and creating new opportunities for businesses. Ultimately, a combination of these approaches can help to create a dynamic and thriving economy that benefits individuals and communities alike. To control inflation. Controlling inflation is a key challenge for most economies around the world. It refers to the sustained increase in the general price level of goods and services over time, which reduces the purchasing power of money. Here are some ways to control inflation. Monetary policy. Central banks can use monetary policy tools such as interest rates and money supply to control inflation. By raising interest rates or reducing the money supply, central banks can reduce the demand for goods and services, which can lower prices. Fiscal policy. Governments can use fiscal policy tools such as taxation and public spending to control inflation. By increasing taxes or reducing public spending, governments can reduce the demand for goods and services, which can lower prices. Supply-side policies. Governments can also use supply-side policies to control inflation. These policies aim to increase the supply of goods and services, which can lower prices. For example, governments can promote competition in markets, reduce trade barriers, and invest in infrastructure. Overall, controlling inflation requires a combination of monetary, fiscal, and supply-side policies. It is important for policymakers to strike a balance between controlling inflation and promoting economic growth. To pay off government debt. Paying off government debt is an important economic goal for many countries around the world. Not only does it help to reduce the overall burden of debt on future generations, it also helps to improve a country's credit rating and increase investor confidence. Here are some additional points to consider when it comes to paying off government debt. There are several ways to pay off government debt, including increasing taxes, cutting government spending, and implementing economic reforms to promote growth and increase revenue. However, there are also potential drawbacks to these approaches, such as decreased consumer spending and potential political backlash from those affected by the changes. It's important to strike a balance between paying off debt and maintaining essential government services and programs that benefit citizens. Some countries have successfully paid off their government debt in the past, such as Canada in the 1990s. However, the process can be lengthy and requires significant political will and cooperation. Ultimately, paying off government debt requires a long-term strategy and commitment to fiscal responsibility. The consequences of printing too much money. Devaluation of the currency. The devaluation of a currency occurs when its value decreases in relation to other currencies in the foreign exchange market. This can happen due to a variety of reasons, such as inflation. If a country's inflation rate is higher than that of its trading partners, its currency may lose value as its purchasing power decreases. Economic uncertainty, political instability, global economic downturns, and other factors that create uncertainty can cause investors to lose confidence in a currency and sell it off. Government policies. Governments can intentionally devalue their currency to make their exports cheaper and more competitive in the global market. The effects of currency devaluation can be both positive and negative. On one hand, it can make a country's exports more attractive to foreign buyers, which can boost economic growth and create jobs. On the other hand, it can make imports more expensive, which can lead to inflation and reduced purchasing power for consumers. Overall, currency devaluation is a complex issue with both benefits and drawbacks. Its impact depends on a variety of factors and can vary widely from country to country. Hyperinflation. Hyperinflation is a term that refers to a rapid and uncontrollable increase in the prices of goods and services. This phenomenon is often caused by a significant increase in the supply of money in the economy, which can be triggered by various factors such as political instability, war, or excessive printing of money by the government. Hyperinflation can have serious negative impacts on the economy, including loss of purchasing power, reduced investment, and social unrest. Some examples of countries that have experienced hyperinflation in recent decades include Zimbabwe, Venezuela, and Yugoslavia. In Zimbabwe, for instance, hyperinflation reached a peak of 89.7 sextillion% in November 2008, leading to significant economic and political turmoil. To prevent hyperinflation, governments and central banks often implement monetary policies such as increasing interest rates, reducing money supply, and implementing fiscal austerity measures. However, these policies can also have negative consequences, such as reduced economic growth and increased unemployment. The role of central banks in money printing. The Federal Reserve in the United States. The European Central Bank in the European Union. The Bank of Japan in Japan. The impact of COVID-19 on money printing. Increased printing to stimulate the economy during the pandemic. Famous quotes about money. Money is only a tool. It will take you wherever you wish, but it will not replace you as the driver. Ayn Rand. Money often costs too much. Ralph Waldo Emerson. Money is a terrible master but an excellent servant. P.T. Barnum. So, should central banks print money or not? There is no easy answer, as it depends on the context, the goals, and the trade-offs involved. Some economists argue that moderate money printing can be a useful tool to smooth out business cycles, while others warn that it can create more problems than it solves. As citizens, we can learn more about the pros and cons of money printing, and engage in democratic debates and decisions about how our monetary system should work. Final thoughts. Money printing may have its advantages and disadvantages, but understanding its purpose and consequences can help us make informed decisions about our personal finances. That's it for today's video. We hope you found it informative and thought-provoking. If you have any feedback or questions, please leave them in the comments below. Don't forget to like, share, and subscribe to our channel for more content like this. Thank you for watching, and see you in the next one.